some big data coming out next week. We don't have a lot of earnings reports left. We don't have a lot of additional data from management. We're going to enter into the blackout period really kind of prior to the next earnings season. And so I think that volatility is going to come along with this approach of us shifting back to central bank policy and understanding that there's some risk in some of these data points coming out over the next couple of weeks, which could upset the trend that has supported the outperformance of those areas.
Jason, what's curious to me is if, Shannon mentioned the idea that there's been a decent amount of multiple expansion. Right. The amount of money we pay for every dollar of earnings a company generates, or expected dollars that they generate in the future. It's all happened despite rising rates. Right. That's not supposed to happen. That's not the conventional wisdom about how markets work. Right. So is this, again, the turning point? Because maybe this does go back to what it should be, which is higher rates means multiple contraction.
Right. So for me, I think there's a couple of things at play. I think about the UAW as an example, as a potentially an inflationary piece where, from a negotiation standpoint, they got to figure out what they want to do from a wage perspective. I think about the mixed bag of commentary we've heard from the Fed this week, right? Some folks are in the camp that, hey, look, we're good. There's no more policy that's necessary to move forward. And others say, to Shannon's point, we need to be data dependent. And I think that puts a lot more pressure on these numbers. And yes, CPI core is supposed to flow down some, next week. But, on the top line, on the headline, I should say, is supposed to float a little bit higher, and that's due to oil prices that we've seen.
What's interesting is what we're showing viewers right now, listeners on Sirius XM channel 112, the Fed commentary has been rather dovish. We got Dallas Fed President Lori Logan saying could be appropriate to skip a rate hike. We've got New York Fed's Williams saying we've gotten monetary policy in a very good place. We have a restrictive stance. We've seen some studies out of the Chicago Fed saying that maybe with lag effects and everything else that we could be at a good place with regard to kind of easing up on some of these, issues that we have in the economy. So, Steve, if you take a look overall at the picture for the economy, this is a situation where the market's debating about whether or not we are at a good place right now, and that if you factor in those quote-unquote long and very variable lags in Fed policy, that maybe things will get better in the coming months and that we can avoid a recession. Is the market already pricing that in?
Yeah, I mean, not to parse words with you, even though I enjoy doing it, Dom.
We know you do.
It's not the last. It's not the last inflation report that's important. It's not the last jobs report that's important. It's the next one, because the last one's already been absorbed into the market. And the next CPI number is important, but it's only important if it goes through the outer bounds of what's expected. So by that I mean you've had the Fed, and this will get to the answer to your question. The Fed's come out. I'd also say they've not been dovish. You can't say that staying in a restrictive policy is dovish. It's not. Right now, they're still hawkish. Dovish would be a real problem, because dovish means they see the need to ease because they believe that the economy is way too tight. So I think that's what's really translating into the market. When they're saying we're at a good place, we're going to be data dependent, which has been consistent, they're saying we think the market's about to go through a rough spot. That doesn't necessarily mean a hard landing. It doesn't mean a recession, but it means that there's been an unusually long lag between the start of our tightening cycle and where the impact is being seen. So that's what the market's worried about at this point. Not worried about September. Throw that crap out. It's just a good talking point. The market's down on average. You go over the last 50 years between 60 bips and 1%. What's that mean? You recover completely and more than that in October. And markets just aren't that easy. We'd say, okay, seasonally, September, tough month. Let me go hide somewhere. So forget it. Great talking point, great way to open the show. Means nothing to what real investors do. Now, if the Fed is very concerned, or is evidencing concern, which I believe they are, that our rate hikes are starting to take effect in the market, then the market is going to reverse that multiple expansion, and we've seen that. Look at where Microsoft's trading. Look at where Facebook, Meta's trading relative to the peaks. So they've come down somewhat. So you've seen that multiple suppression somewhat. And I think that could continue because I do believe the economy will be weakening. We'll still see strong data points like ISM, but overall, the trend, I believe, is lower, and that's why, again, the market's been weakening over the last month or so.